Hi, I'm Rick Hough, Chairman and CEO of Silvercrest Asset Management. I'm here with Robert Teeter, Chief Investment Strategist of the firm, to once again talk about developments in the markets and economy on the heels of the cut in Fed interest rates. Hi, Rob.
Hi, Rick. Great to see you again.
Good to see you. So just before I came in, I walked into your office and there was a T-shirt draped over your desk. Don't fight the Fed.
Don't fight the Fed.
What was that about?
They are a formidable force, a long-time popular expression for investors, and one that's probably coming a lot more into focus here now as we see Fed policy changing again. They had been on an extended pause, now embarking on another rate cut today of 25 basis points, and we can talk more about the path ahead. But the old adage rings true here, I think, especially in this environment of don't fight the Fed. If the Fed is giving you some accommodation, that tends to mean there's a tailwind for markets. And if they are taking away accommodation, that means there's a headwind for markets.
Monetary accommodation, liquidity, right?
Yes.
I think I've mentioned this before in our prior podcast. I kind of don't like all of the attention on the Fed, right? There's a real economy out there.
Absolutely.
People building real things and selling products, and obviously, interest rates have a very important effect on companies and the economy, but sometimes I feel like our markets get obsessed with the Fed and ignore what's really happening in the economy.
Yes.
You were in favor of this Fed cut, right?
Yes.
Why don't you talk about that first, why you're happy to see it, and then we can talk about some of the implications.
Yeah, absolutely. And I'll start even right where you led into the question, which is there are times when the Fed doesn't or shouldn't matter. In other words, when policy is seen as relatively neutral and has been stable for a long period of time, sort of what's the difference what the Fed's doing? The situation that's evolved more recently has gotten a lot more complicated with regard to state of affairs for the economy, which has been strong but growing a bit more slowly, for inflation, which has been less of a problem than it was a year ago, but still above the target rate that the Fed would like to see. And the reason I was in favor of this cut and why I'm happy that they're doing it is they are doing it in a way to remove some restrictiveness from the economy. So there's a concept of what level is neutral with regard to the Fed funds rate. It's an unknown question, but in my view, it's probably current state of affairs around 3 to 3.5%. And with Fed funds before today being at 4.5%, they were clearly pushing on the brakes a little bit with regard to the economy. So I'm happy that they're starting to remove some of that excess restrictiveness and sort of allow the economy to grow a bit faster.
Is this compounded by another figure you look at, the growth in money circulating in the economy, the growth of what is called M2, but it's effectively the amount of ready currency that is in the economy for transactions?
Yes, that's another very important element, as is the Fed balance sheet. I think the focus here and the reason why it's been so much on rates is that there's part of the process of normalization, which will take a while. There's also the direct pass-through effects of the change in rates. And while 25 basis points won't make a difference, if they eventually are cutting by 50, 75, 100, that will then start to flow through to market interest rates, which has a variety of wide-ranging effects. So whether that's mortgage rates or rates on the 10-year bond, which are very actively
and you see that
traded.
flowing through with this 25 basis point cut as well, right?
Absolutely.
Okay.
In fact, one of the most interesting dynamics this year was that we came into the year, and I like to look ahead somewhere between 6 to 12 months and see where market consensus is for Fed funds. So looking at June of 2026, we came into January, and consensus there at that point in time was that Fed funds would be right around 4%. So maybe a half percentage point of cuts between now and June. Presently, right before this meeting, that number was more down to 3%. And that has a lot of implications, both signaling wise, if companies are acknowledging that likely money will get a bit less expensive over the next year, that helps in forecasting and making plans, as opposed to when the Fed was very clearly on a strong pause and not making a change. You sort of didn't have anything to look forward to, and you knew where rates were for the time being.
Yeah, that makes sense. What I was getting at with the liquidity, M2, actual money creation, was just that has been on pause for quite some time now since COVID. and that's its own restrictive element. So
It is, yes.
in effect, our policy has been on pause or even getting more and more restrictive as the economy grew.
Absolutely.
With the higher interest rate plus the lack of any money creation.
Yes.
Which has also actually been fighting inflation, right?
That's right. Yeah,
Okay.
Spot on there. And I think this is the first small step in what will eventually be a long journey in
Right.
all of those metrics.
Well, let's talk about the long-term
Mhm.
implications for this small 25 basis point reduction. Who
Right.
knows if it's the first step of many or what it may be. What do you see as the longer-term implications for the economy and for the market?
Yeah, so for the economy, it should help to extend this cycle somewhat. So there has been a slowdown in labor markets. So the adds to payrolls have been declining. There's a whole host of issues there, and I actually think it's not as bad as it seems in terms of the slowdown.
Let me just interrupt you there,
hiring.
because I know you have a list of things to go
Yeah.
through. It has been slowing, but there was also this massive revision to
Yes.
jobs last year. Can you talk a little bit about that, what the implications of having that revision are, and what it says about where we were with the economy and what that may portend for the future?
Yeah. So two important parts of that. So there was a revision that basically meant that in the past year and then the year prior had the similar revision, there were fewer jobs created than originally estimated. So that means that hiring was slower than originally estimated, labor market a bit weaker. However, that doesn't change the fact that we do have data on where spending were during those periods of time. So it doesn't necessarily mean the economy was weaker, but it does mean the labor market was weaker. And now we're starting to see the labor market more consistently weak and less hiring. One of the reasons I'm not as concerned about that right now is that there seems to be an unfolding theme in corporate America of holding hiring flat and becoming more productive. And part of that, I think, is related to things that people saw and adapted to during the pandemic. Part of it is companies making adjustments for COVID, and part of it is, for tariffs, and part of it is for companies being able to deploy technology better.
And we're going to get to that
Yes.
technology point, because it's a very important one with regards to inflation as well as the future growth of the economy. So you mentioned jobs. Let's talk about the other long-term implications you see of this 25 basis point cut.
Yeah, so really three layers. So on the economic side, extending that cycle. From a market standpoint, it does also help in that when we look at valuation, multiples on equities, and think about where should they be and where will they be in the future, stocks are fairly expensive right now. They're in about the top 8% versus the last 30 years or so, historically speaking, kind of pretty elevated levels. And then there's a big jump up to where things were in the 90s, and we're certainly not there. So I view it as we're kind of at the higher end of normal. Because of that, these interest rate cuts will help a lot in terms of supporting those valuations. The classic model is basically the lower interest rates are, the higher a valuation metric you can support. And of course, the higher interest rates are, the lower valuation should be. So that helps a lot from a market standpoint. And then the third level is really at the kind of the combination of those two things. In other words, the economy and the market. You should expect to see more companies succeeding in this environment, partly because there will be slightly stronger growth, partly because there will be slightly lower financing costs. And I think that's a really encouraging dynamic as we think about investing. There should be more opportunities for more companies to be more successful.
So you combine more opportunities to finance growth, to have growth,
Yep.
and to discount effectively the earnings that are made at a lower rate.
Yes.
Then you have a little more support in a very expensive market.
Yes, absolutely.
Okay, is that fair?
Very great summary.
Okay. All right. Well, then let's talk about the risks in the market. The market, as people call it, is of course different from the economy at large.
Yes.
The companies in the stock market that are publicly traded tend to be able to compound earnings faster than the rest of the economy, or your normal companies. They're very high quality. That's why they're public, by and large. I'm painting with a broad brush. They have scale, right, which helps them, competitive advantages, et cetera. what about this expensive market that you see, especially concentrated in very large tech stocks? And what are the implications for them? And what are the implications for an investor trying to diversify their portfolio?
Yeah, it's a very important issue, and probably the most important issue related to results that people have seen in their portfolios in the past several years. And there's a few important points to consider. So one is when the markets are this concentrated and this highly valued, there is a higher level of risk if there is a stumble, let's say. That's a typical term used for if companies are failing to deliver. And so if within that cohort of large, very successful companies, you start to see some companies not succeeding as much, the downside is a lot greater in terms of what could materialize. For the time being, that doesn't seem to be happening. And in fact, the valuation level of those companies, while elevated, is, in my view, mostly justified by how quickly they're growing, how strong their balance sheets are, et cetera, et cetera. And they're very, as you said, high quality companies with a lot of growth potential. So that doesn't concern me that much. What is exciting is the potential for market success to broaden beyond those names, particularly now that you have some visibility on interest rates coming down, and you're starting to see some improvement in terms of deal activity, both of which benefit the broader market much more than the large
Tell us
piece.
how and why.
Yeah. So we have basically been outlining multiple catalysts for a market broadening beyond the biggest names. And then one of the important nuances in how we've looked at the market is not to dismiss the big companies, but rather to say, what will get the rest of the market coming along. The healthiest market, as everyone will always say, is a market that's much more broad and driven by gains in a lot of companies. So our question in reviewing this is, well, what will cause that to happen? And both in looking at history and thinking about the fundamentals of these companies, the framework, at least from my standpoint, seems to be three catalysts. The first is interest rates coming down. That boosts economic growth, which tends to be better, all else being equal, for smaller companies. And it reduces the financing costs, of which smaller companies are more sensitive to than large. The second thing is improved deal activity. And everyone was very excited about this at the end of last year.
Mergers and acquisitions.
We've talked about it before, and things sort of went on pause with the tariff news. And I think we mapped out that scenario pretty well in the conversation we had at that point in time. And now that's started to pass, and companies seem to be engaging in more deal activity again. That's good for a broader section of companies because bigger tend to acquire smaller, and so you get a benefit.
You get a premium on their price in the market.
Yes, and so you get a benefit to some of the smaller companies.
Mm-hmm.
And then lastly, we think the declining costs of a lot of this technology will allow it to spread to a broader segment of the economy and to more companies. Right now, it's very easy to think about how tech gains can help tech companies in terms of being productive. And you look at headcount, and it has been flat the past couple of years, and they're growing revenues at really rapid rates. But those same tools will be deployed across the broader economy, and that will help more companies make more money, which is good for their stock prices.
I'm seeing it absolutely everywhere.
Yes.
On that theme, because you've both mentioned technology and inflation.
Yep.
That was the big story earlier this year.
Yes.
There are still lots of questions about the tariffs and
Yeah.
the tariff policy. There's been a lot of other news. Where are we with tariffs?
Yep.
Was the inflation hit one time?
Mm-hmm.
Is there still more to come? What are the implications of just the tariff policy?
Yeah. So we actually had a really in-depth conversation about this in another meeting here today. And it's interesting in that understanding what's happening with tariffs really requires mapping out and modeling out each tariff rate, each country, the percentage of imports in the U.S. economy, and so on and so forth. Very many people have sort of taken a view of tariffs textbook-wise, that's bad. It's a drag on growth. It's an increase to inflation. That is absolutely correct. However, when you start to do the math and look through, here's how much is coming from different regions. Here's some regions that have lower tariff rates. Here are ways that companies can change how they're purchasing things to purchase from lower cost regions. Here's substitutions. like we saw in the pandemic when people stayed at home and weren't using services but were acquiring goods. The opposite is true with tariffs. If you're trying to buy goods and they're more expensive, you might purchase services more as a consumer. And so there are all these different mitigation effects. And then you get down to the individual company level. And I think a lot of people have talked about there only being two tools to deal with this. One is pass it on to the consumer, and the second is to eat it in profit margin. But it seems that many companies are engaging a third tool, which is let's get more productive and reduce costs elsewhere as a percentage of sales.
And on that theme,
yes.
how are they doing that? What do you say?
So one of the things I do is I use some technology tools, AI, to go through company transcripts and identify references and instances of not just AI as in AI is exciting and that's
right.
the only thing that's been said, but
actual implementation.
Yeah. And looking for quantitative metrics when things are referenced, such as, this is not a specific example, but right. In a prior world of this expansion of our revenue and customer base, we may have hired 500 new employees and we've only hired 100 because we are utilizing A, B, and C
right.
technology tools to help with our efficiency.
Mm-hmm.
Those are the things that I look for, and those are starting to spread more broadly. And I think that's one of the keys to offsetting some of the tariff costs.
Is the flip side the slower hiring, or is that probably due to something else?
There's a combination of effects there. I do think some of it is related to that, and you see it in the higher unemployment rate for people newly out of college.
Yes.
And that's an area
that's been
where
making news lately.
It has been making news. And that's clearly an area where some technology could be substituted for that labor. There's also some commentary from economists talking about the change in net immigration is fewer people in the economy and a bit less hiring. That's another influence. There are a lot of different things that have gone on. We sort of went through a bust and a boom in hiring that's normalized. You do have fewer people coming into the country, but I do think that the tech theme is a very real and important influence on what we've seen in labor. And it doesn't necessarily indicate that there will be layoffs or a recession, but it does indicate that perhaps hiring growth could be slower.
So you're seeing real effects of AI,
yes.
or at least other AI-related technological advances,
right,
helping with inflation,
yeah.
helping with, therefore, the effect of tariffs.
Yeah.
Comes with some downsides,
yeah.
but over the long term, it's probably a positive for growing companies and the economy. Is that a fair summation?
It's very fair. And I liked the way that you characterized AI and other, because I do think a lot of people instantly hear AI and they think just of the LLMs, and there is,
large
of course, a lot
models,
more to it than that.
You put in your phone and
exactly,
tell you how many calories is in it.
Right. So that's one part of it, but
right.
there are a lot of other things that people are doing. So I appreciate your characterization.
It just, when you read the news, there's a lot of hand-wringing about it being overhyped,
yes.
much like a lot of the tech innovations with the internet.
That's right.
In the 90s with the tech bubble were potentially overhyped.
Yes.
And got ahead of themselves.
Right.
But not overhyped when you look at the long term and the
yes.
transformation it's had on our economy and lives. We can't even imagine,
yes.
For those of us old enough, we can't even remember what that world was like.
Yes, absolutely.
And there may be a mix of these things. There may be some over exuberance with AI and pie in the sky thinking, right. But on the other hand, there are real applications, and some of them are very, very specific and have tight applications to a problem a business has.
Yes,
and isn't related to.
Absolutely. And just even better data analytics and
right.
better decision making for large companies.
And that's why I was thinking of it in those terms.
You're smart to characterize it that way. And that's the exciting part.
I love being flattered.
It spreads
Rob.
a bit.
Thank you.
Anytime. It spreads very much from those creators of those tools to the users of them. And that's where you could see some of these really exciting benefits
right.
for the economy and market.
So we started with don't fight the Fed.
Yes.
I don't like fights. I don't want to fight them. So you see this constructive. You were in favor of it. Mm-hmm. You explained why. Now we're going to go into ground that I'm not as comfortable with.
Okay.
Because I don't, again, like too much speculation
mm-hmm.
on it. Do you see further rates yourself? And would you be in favor of further rate cuts, or is it too early to say?
I think it's highly likely. The language I heard today out of the press conference indicated that people on the Fed were projecting the potential for 2 more cuts this year. I think 1 or 2 is very reasonable. It's all, as they have characterized it, very data dependent. And I do think that what's happening here is that given the slower pace of labor market expansion, they're using it as a opportunity to reduce some restrictiveness. I don't think it will go too far, though. So if you said, all else being equal, meaning labor markets stay about where they are, inflation stays about where it is, if I look out into next year, I could see rates settling in maybe around 3.5% or so. So nothing too dramatic.
Which, to go to your earlier comment, was close to neutral?
Yes.
And you think it would be around that time as well?
Yes.
Okay.
Yes.
Thank you, Rob. Always
Thanks, Rick.
appreciate your observations.
Great chatting with you.